I'm telling you, you're going to hear more about gold revaluation, about dollar devaluation, about lower interest rates, about Fed losing independence, about a shift, a rotation, as Michael Oliver calls it, once in a 50-year rotation from one asset class to another. These things are all converging. So I don't know. This is the time, and I'll stick by that, and I mean it.
Silver is standing on the edge of a
You're watching
once-in-a-lifetime
Silver
eruption,
News Daily. Subscribe
and
for
almost nobody is prepared for what's coming. A 50-year mega rotation is now underway, and it's rewriting the rules of global finance. The Federal Reserve, once seen as the last pillar of stability, has surrendered its independence under political pressure, setting off a chain reaction that could obliterate the dollar. Central banks aren't blind to this. They're quietly dumping U.S. treasuries and hoarding gold at record levels, while BRICS nations are accelerating their plans to dethrone the dollar's global dominance. But here's the twist. Gold may already be the headline, yet silver is the wild card that could leave even seasoned investors stunned. At just over $30 today, silver looks cheap, even boring, compared to gold's historic highs. But behind the scenes, the pressure is building. Price suppression through Wall Street games, surging physical deliveries on Comex, and a historic industrial boom are all colliding at once. When this dam finally bursts, silver won't just double or triple. It could ignite a parabolic surge toward $500, shattering everything we thought we knew about precious metals. So the question is, what exactly is fueling this rotation? And why does it make silver the ultimate play in the collapse of the dollar? Stay with me, because the answer is more shocking than you think.
Into rising inflation, here we come, stagflation. And for the first time since 1996, central bank gold holdings surpassed those of U.S. Treasuries. This is the ramifications. And we saw that potential earlier this week when the central bank announced more and more countries are starting to do this. When we saw earlier this week, El Salvador's central bank revealed that it had bought gold for the first time in 30 years. It bought 14,000 troy ounces, $50 million worth. It's interesting that it used the proceeds from its Bitcoin reserves to fund the purchase, something that it's the opposite of a lot of the talk we hear around here. Speaking of Fed independence, sorry, I'm just going through some notes that I have here just to kind of touch what I thought was relevant this year or this week. Trump has signaled he wants to appoint someone who is more inclined to lower interest rates, with a point which he has, been very adamant about. Again, Fed losing independence. Goldman Sachs says the market gets one whiff of that. 1% move out of treasuries is 5,000. What if it's 2%, 5%, 10%? The very wealthy people. So here's the thing. He wants to lower rates. Right now, with the 10-year treasury at 4.5% and the CPI nonsense inflation saying that, okay, well, that's a positive 1.5% or whatever, and we know it's a lie. We know it's a negative yield, real yield. But if he wants to lower it by what he says as much as 300 basis points, well, then even using the same CPI numbers, you're going to be real negative yield in your face, not just the make-believe stuff that they hide on the CPI, but in your face. And the wealthy, sophisticated people ain't going to stand for that. They're not going to do it, period. They will move to gold. And that's why you see big money in central banks, I believe, have been preparing in earnest for this. Look, you're seeing all of this stuff happen without any meaningful retail participation. So, as always, the little man rule done again. The big money is front running what may be a bull market of a lifetime, because in gold's case, it's not gold going higher. It reflects the loss of purchasing power of the currency. This is why when people say, how high can gold go? The answer is, how low can the dollar go? Franz Pick used to say all currencies, fiat, are inherently meant to die. In essence, it could go to infinity. Now, I'm not saying that's going to happen, obviously, but, I just think that people could benefit from diversifying more heavily into gold and silver like the central banks have. Goldman Sachs sees the scope for prices to move well beyond 4,000.
For more than a century, the Federal Reserve has been portrayed as an independent guardian of the financial system. But that image has now shattered. Under relentless political pressure, the Fed has caved, aligning its policy decisions not with economic logic but with the demands of the White House. This surrender marks a historic turning point because it signals to the world that the U.S. central bank is no longer an impartial referee, it's a political tool. And when the world's largest reserve currency is managed for politics instead of stability, confidence unravels quickly. We're already seeing the effects. Inflation remains stubbornly high, yet instead of holding the line with tough policy, the Fed is prioritizing short-term optics. Interest rates are being manipulated, not to fight inflation, but to protect stock markets and political popularity. This is exactly what foreign creditors feared: the weaponization and degradation of U.S. monetary policy. And when confidence in a central bank collapses, so does the value of its currency. What's unfolding is bigger than a simple policy mistake. The Fed's credibility, built over decades, is gone. The world now knows the dollar is backed not by discipline, but by desperation. And this collapse of independence is the spark that ignites the capital rotation away from paper promises and toward real, tangible assets like gold and, even more explosively, silver.
In just about anything that you measure it against, in all valuations, don't measure it against the dollar, measure it against gold, and you'll see in terms of gold, things are getting cheaper. And I expect that the price of gold only goes higher because, as Michael Oliver, who you have on your show all the time, he's talking about a real massive capital rotation from Western mainstream legacy investment stocks, bonds, etc., into precious metals. He says this happens but once only every 50 years. Doing a little bit of reading this weekend, found it very interesting that before Scott Bessent became the U.S. Treasury, he wrote this. I'm going to read it from his January 2024 Key Square Capital Management letter. And then I want you to think about where we are right now today and his role in all of this. We believe that this, and again, he was writing this for a letter. He was a capital management letter that he was working for in 2024. We believe that this inappropriately easy policy, monetary policy they're talking about, inflated the dot-com equity bubble. Our best case is that a re-elected Donald Trump will want to create an economic Lollapalooza and engineer what he will likely call the greatest 4 years in American history. In this scenario, here's the important part. The greatest risk factor, in our opinion, would be a sudden rise in long end rates. I find it interesting. I think this explains why he's so much into gold, and this is where we're going. This is the path that we are heading on. I also found it interesting that Bessent just also advocated for a comprehensive, independent review of the Federal Reserve. He called for scrutiny of the entire operation, its monetary policy, its regulation, its staffing, its communications, blah, blah, blah. He argues that the Fed has strayed beyond its mandate and needs to regain credibility as a non-political institution. He said that the Fed should relinquish its banking supervision duties and limit economic intervention, particularly unwarranted bond purchases outside of crises. But this aligns with President Trump's effort to increase influence over the Fed. So if that happens, you look at Stephen Mirren being put in and Trump's attempt to sever the independence, if you will. Isn't that exactly what Goldman Sachs was warning about? That the political control harms its credibility, increases inflation, undermines its trust. Bang, gold goes to 5,000. So it's happening right now. I mean, you can see it as being undermined. And so, I think that, one should expect gold to go much higher in the face of a dollar going much lower and the Federal Reserve losing independence, as Goldman Sachs says so eloquently.
The dollar's decline is no longer a prediction. It's a process already in motion. For decades, the U.S. has relied on its currency's reserve status to fund massive deficits and endless debt creation. But that privilege is now eroding. Stagflation is back, crushing growth while prices continue to rise, and the world is waking up to the reality that holding dollars is a losing bet. Look at what central banks are doing, not what they're saying. For the first time in history, they now hold more gold than U.S. treasuries. That's a stunning reversal of trust, and it tells us everything we need to know. Confidence in American debt is collapsing. With $35 trillion in national debt and unfunded obligations far beyond that, the dollar can no longer serve as a safe haven. It has become the very source of risk. As global trade shifts away from dollar settlement and nations search for alternatives, every new blow chips away at its foundation. Oil deals bypassing the dollar, sovereign wealth funds diversifying into hard assets, and the quiet but steady dumping of treasuries all point in the same direction. The dollar's era of unquestioned dominance is ending, and in its place, real assets are being revalued to reflect this seismic shift. Gold has already broken records, but silver, vastly more undervalued, is the pressure valve waiting to burst open as capital flees the failing currency system.
To have a treasury that is projecting well north of 22 to 25 trillion in debt in the next several years, with our foreign creditors who have supported our lifestyle backing away, I mean, I don't know, isn't it always been the Fed that stepped in and with more money printing, risking inflation? I don't think this is panic. This is a sober reality. Confidence in the dollar is slipping, and gold and silver, with its long-term 5,000-year track record. Speaking of 5,000, that's the number that we're getting out of Goldman Sachs if just 1% of the money that's in treasuries pulls out of treasuries. Bald Guy Money did an interesting one, and he said if 20% pulled out, he was getting $9,000 gold. And it wouldn't surprise me. And then they revalue it. The higher the price of gold goes, only benefits this country on many levels, not only through the devaluing of the dollar, but also, of course, the ability to, if Judy Shelton is right, peg gold to the back end of the treasury. You know, this will probably, I doubt people would get this, maybe people watching your show, but if you bought, what do you think was the best performing asset if you bought the day Nixon closed the gold window on August 15th, 1971? Well, obviously I'm asking the wrong crowd, but number one was gold. Number two was the S&P 500. Number three was the Dow Jones. Number four was silver. And this is including reinvesting every dividend for compounding gains, which no one ever does. Investors never do that. But if you had invested every single dividend for the past 54 years, gold is still outpaced the Dow and the S&P. Silver came in just behind those at number four, but it goes to show the old adage that Wall Street wants us to believe that because there's no yield on gold, you should have known it. It's actually a
BRICS and the world's central banks are no longer just talking about de-dollarization. They're executing it. One by one, these nations are reducing their exposure to U.S. treasuries, cutting back on dollar reserves, and building massive stockpiles of gold. China has led the charge, dumping hundreds of billions in treasuries while simultaneously importing record amounts of bullion. Russia, sanctioned out of the dollar system, has already reoriented trade toward gold and local currencies. India, Brazil, and South Africa are following suit, forging new trade agreements that deliberately bypass the dollar. This shift is not symbolic, it's structural. U.S. debt, once the most trusted collateral in the world, is now seen as toxic. Yields are soaring, demand is drying up, and even traditional allies are quietly reducing their treasury holdings. Meanwhile, the IMF and BIS are openly acknowledging that the global financial system is fragmenting into a multipolar order. In this new landscape, the dollar is no longer the default choice, and every treasury dumped creates demand for real assets. Gold has become the safe anchor, but silver is emerging as the overlooked weapon in this capital rotation. When central banks drain treasuries and redirect even a fraction of that money into precious metals, the impact on silver, already in deficit and undervalued, is exponentially larger. What we're witnessing isn't just diversification. It's a global vote of no confidence in the dollar, and silver stands ready to be the explosive beneficiary of this great exodus from paper wealth.
And no one really is talking about it, which is kind of crazy. And, look, I think it's most important to understand that this is not gold going up. It's mostly currencies everywhere depreciating against gold, not just the dollar, but all currencies. And I don't know, it's not only a normal bull market, which I see very clearly, but it's also a monetary system reset, which I see very clearly. And when you see an environment where foreign governments and central banks hold more gold than U.S. treasuries, it's a sign that they trust gold more than they do the dollar and our debt. This is a big deal. This is a monetary reset. This is a reshuffling of the deck. I think people need to understand that. It's crazy that this isn't all over the mainstream, that this isn't spoken about. It's shocking to me, and it makes my disdain for the legacy media grow by the day. Look, our massive debt means that we will almost certainly rely on money printing to pay it back, which erodes the value of the dollar. Foreign holders of our treasuries and our dollars do not want inflated dollars, so they too are shifting into gold. And it's because of the credibility, the liquidity, the physical security. This is what has shifted gold's bull run from 1,700 to 3,500 an ounce in just the last 3 years. And then at the same time, you got momentum building with guys like Putin and Xi and Modi, who are openly urging trade in local currencies, which again are laying the groundwork for a world less dependent on the dollar, Dunnigan. And that's, this is what it is. It's not so much gold, it's the dollar. It's everything. Gold is the barometer by which we measure everything else. And when
Just before we get going, we just launched the official Silver News Daily Telegram. To kick things off, we're running a 10-ounce silver giveaway. Yes, real physical silver, not a voucher, not digital credits, actual bullion. This Telegram will be our new home for real-time silver discussions, market insights, collection picks, and everything precious metals. It's where the community truly comes alive. Here's how to enter the 10-ounce silver giveaway. Be subscribed to Silver News Daily on YouTube. Turn on the notification bell. Comment 10-ounce giveaway on 3 separate videos. Be an active member of the Telegram group and say hi. Once we hit 500 active Telegram members, we'll pick one lucky winner to receive 10 ounces of silver
For years,
shipped directly
silver's
to you.
price has been
So get in
shackled
early,
by Wall
stay
Street's
active.
paper games, and the biggest culprit is SLV, the world's largest silver ETF. Controlled by giants like BlackRock and JP Morgan, SLV was designed to give investors exposure to silver. But behind the curtain, it's become a tool of suppression. Right now, nearly 54 million shares of SLV are shorted, a staggering number that creates artificial supply and drags the price lower. The catch? Much of this silver doesn't actually exist in physical form. It's just paper. This manipulation works as long as investors stay complacent, content to hold ETF shares instead of demanding delivery. But cracks are already forming. Inflows into SLV surged in 2024, yet physical deliveries lagged, raising serious doubts about whether the metal is really there. If too many investors start asking for bars instead of paper, the custodians could be caught short, triggering the very scenario they fear most, a short squeeze. And history shows how violent that can be. When supply is cornered and shorts are forced to cover, prices don't just rise, they explode. Analysts warn that if physical demand collides with today's bloated paper shorts, silver could leap overnight to $50, $70, even $90 an ounce. That's still only the beginning compared to its true potential, but it highlights the danger of years of suppression. Wall Street has built a spring, wound tighter and tighter by endless shorting, and when it finally snaps, silver will not just move, it will detonate.
That's just it. It's not. Shifting gears a little bit, we've talked every single month since the beginning of the year about all of the gold being delivered into Comex. Not all of it is leaving. A lot of it is. So far, there's been just shy, 3,626 contracts. I read this over the weekend, so I don't know how many more have stood for delivery. That's a $1,305,000,000, $360,000 worth of gold in just the first few days of the September contract. At the same time, there was 10,599 silver contracts delivered. That is worth $2,225,790,000. So, I mean, every single month there's billions and billions and billions coming in, and before it's all said and done, it'll even be more. People wonder ways by which they hold the price down with all of these deliveries. One of the ways is through GLD and SLV. In SLV right now, the short position, which is controlled, by the way, SLV by custodian is BlackRock and JP Morgan. The short position in SLV increased by almost 20% to 53.97 million shares. And as Ed Steer says in his own words, this is fraudulent beyond deception, as there is no physical silver backing any of it, as the SLV prospectus requires. Crazy, to be honest with you. It truly is. You look at a period of time where all of this metal is coming in, where deficit spending has gone so far out of control that the Fed is really losing control of interest rates, in my opinion. And the U.S. has issued over $200 billion of bonds in 5 weeks. Then again, we're reaching a point where investors don't want to buy U.S. government debt at current yields. And let's talk about what's happening around the world. In the UK, 30-year bonds have broken above 5.7%. for the first time since 1998. But the crazy thing about that, think about what Trump wants to do, right? Remember last time the Fed lowered rates by 100 basis points? What happened to the 10-year? It went up by 100 basis points. Well, the Bank of England has cut rates 5 times this year and ended up with rates at a 27-year high. How the hell does that happen? So the market is literally rejecting interest rate cuts due to deficit spending and inflation. So when the Fed cuts rates in 2 weeks and blames a weak labor market, are we next? Is this going to happen to us? You got the U.S. unemployment rate for 16 to 24-year-old kids at 10%. And not to mention all the revisions we have seen, the labor market is weakening.
The quiet war over silver isn't just being fought on Wall Street. It's spilling into the physical markets. And nowhere is that clearer than on Comex. In just the first weeks of September 2025, over 10,500 silver contracts were delivered, representing more than 52 million ounces and a staggering $2.2 billion in value. These aren't paper bets. These are institutions and sovereign players demanding the metal itself, pulling it out of the vaults and into their own hands. Year to date, deliveries have already topped 60 million ounces, a 15% jump from last year, and inventories are shrinking fast. Comex registered silver has dropped from 330 million ounces at the start of 2025 to barely 300 million today. That may sound like a lot, but in the context of global demand, it's a razor-thin cushion. 1 or 2 large buyers, say a hedge fund or a foreign government, could drain that supply in months. This is the kind of pressure that exposes the system's fragility. Comex was built to trade contracts, not to serve as the world's physical silver bank. Yet more and more players are treating it exactly that way, demanding delivery instead of rolling contracts forward. Every bar that leaves the vault tightens the noose, and with industrial demand already devouring supply, the margin for error is vanishing. If this trend continues, the day will come when Comex inventories can't meet delivery requests. And when that moment hits, the paper price of silver will be forced to reprice violently higher to match the reality of scarcity.
I mean, the old bag of tricks would be you put it into treasuries earning a fair rate of return and let the laws of compounding be your friend. back in the day with 9% interest every 8 years, your principal would double. And, if you had 9% interest and millions of dollars, that's fine. Double every 8 years. The law of 70 seconds, 9 into 72 is 8. Problem is that where we are right now, the inflation is far higher than the rate of return. And so a real negative rate of return makes bonds a no-starter. I mean, it's a no-go. And so then what? Do you put your money into an equity market where valuations are higher than at any time, even the 1929 crash of the stock market, anytime ever, at a period of time when you have the largest ever margin debt by the retail public, the largest ever exposure to options by the public, and the largest ever participation in the stock market by the public, as the insiders are literally moving the other direction. You put it into real estate when 30 years worth of suppressed interest rates have created great distortions. And where do you put it? I guess, municipal bonds, but aren't the municipals or the municipalities in trouble?
Right now, the gold to silver ratio is screaming that silver is the most undervalued major asset on the planet. With gold trading at $3,640 an ounce and silver barely above $31, the ratio sits around 90 to 1, double its 100-year average of 45 to 1. In plain terms, it means silver would need to nearly triple just to catch up with its historical relationship to gold. Think about what happens if that ratio simply normalizes. At 40 to 1, with gold holding steady at today's levels, silver wouldn't be $31. It would be closer to $90. And if gold continues its march higher, as many analysts predict, that target only grows. Peter Schiff and others argue that $5,000 gold would drag silver to at least $125, if not higher. But that's just the conservative math. The real shocker comes when you consider the geological ratio. For every ounce of gold in the Earth's crust, there are roughly 7 ounces of silver. If the market ever reprices silver according to that natural ratio, you're looking at numbers not in the tens, but in the hundreds. $500 silver becomes a plausible outcome. It sounds extreme, but remember, in past crises, silver didn't just follow gold. It overcompensated, exploding far beyond expectations. The ratio is the clearest signal flashing red today, and it's telling us silver is coiled like a spring, waiting to snap back toward its rightful value.
There's no question. You're seeing, the numbers in all of vaults, except the LBMA, which is going the opposite direction. But yeah, you're seeing massive. I mean, we're seeing really large orders even in the retail side. We're just not seeing the huge volume. But 7-figure orders are no longer the exception at all. But yeah, you look at the Comex numbers, there's a massive amount of hoarding. You look at the amount going into the world's ETFs, it's huge. So I hate that part of it, SLV, which is really a tool for manipulation because of the naked shorting. I would much rather see the money go into physical and drain. When you look at like Saudi Arabia, who took this huge position in SLV, the one saving grace is the position is large enough to where they can demand delivery. And it's like when the Texas Teachers Union, which was being run by Kyle Bass years ago, put $1 billion into gold. He took possession out of GLD. So, but just simply at face value, yes, that is true. The ETFs and many of the Western exchanges are seeing record inflow, not all of it leaving. And the numbers, the eligible numbers, are going much higher. But there is some leaving, certainly. But you're right. It is very obvious that there is a huge amount of hoarding. This will promote, very possibly, that short squeeze that everyone's been waiting for, because there's just not enough in the way of those size good delivery bars in the West to really to protect. In fact, even BlackRock wrote in the prospectus of SLV that be careful if you're short, because there could come a time when there isn't enough silver to cover those positions, and it's a big threat. Now you're talking a squeeze and the price goes up parabolically and bankrupts people. So ultimately, that would be where I think this is hedging or heading to. The first step would be taking huge positions and hoarding it, not selling it at prices anywhere near where we are now, because, just taking where we are right now, if you look at gold right now at 3640, call it, and if we divide 3640 even by 70, which is way higher, that's $52 right now. It should be massively higher than it is right now. And if you did it by the average, even call it 40 to 1, where it's been about 45 to 1 for the last 100 years on average, you're looking at $91 an ounce silver. Is that out of line? No. And at 45 to 1, it's still 7 times higher than it's coming out of the ground at. So, 91 times 7, in theory, $700 an ounce silver. I'm not saying that's going to happen, but I mean, is it the craziest thing to think of? If you take 34 or 3640 divided by 7, which is the geologic ratio, it's actually 520. So let's get a little bit more realistic. But $520 would represent the current geologic ratio. But what happens if gold keeps going? Put gold at $5,000 an ounce, like Goldman says, and divide by 70, and you got a lot. You got $350. Or put it at $5,000 and divide by 90, where we are right now, $55. Silver's going much higher, for sure.
Silver isn't just money. It's industry's secret weapon. More than half of global silver demand now comes from industrial applications, and that share is only growing. In 2024, over 700 million ounces were consumed by technology, and 2025 is on pace to hit 750 million. Solar panels alone devour around 200 million ounces each year, and that number is climbing as governments pour trillions into renewable energy. Unlike copper or aluminum, silver can't be substituted in high-efficiency photovoltaics. Its conductivity and reflectivity make it irreplaceable. Then there's the electric vehicle revolution. Each EV uses up to 80 grams of silver across its circuitry, batteries, and charging systems. Multiply that by the millions of EVs rolling off assembly lines annually, and the consumption numbers become staggering. Add to that the explosion of AI-driven data centers, advanced electronics, and even medical technologies, and you get a demand wave unlike anything the silver market has ever seen. This is what makes silver fundamentally different from gold. Gold is hoarded, but silver is consumed. Once it's embedded in a solar panel or an EV battery, it's effectively gone, locked away and uneconomical to recycle. With industrial demand surging, every ounce pulled from Comex vaults or mined from the earth is being absorbed permanently. And when supply can't keep up with this supercycle, prices don't just drift higher, they snap violently upward, reflecting the desperation of industries that can't function without this metal.
Revising 1 million out of the 1.76. I think, let's see, I got maybe 2 or 3 more things left to say. I found it interesting that Trump says that the United States has lost India and Russia to China. And he said, may they have a long and prosperous future together. That's what he came out and said that. And maybe that's because both India and China confirmed to boost their ties to reduce the effect of Trump tariffs at the Shanghai Cooperation meeting. Moody called for stronger relations between the Asian neighbors to minimize the impact of the decisions made by the U.S. without naming Trump. Modi on several occasions called out the West for selfish decisions and vowed that India would never compromise on the requirements of its people, especially their farmers. Not sure what that's all about. I did find it interesting that in an official statement later in the evening said that the SCO had decided to establish a development bank and accelerate consultations on a series of issues related to the financial institution's operation. In other words, this is going to be connected also hand in hand with the BRICS New Development Bank. Now you have the Shanghai Cooperation New Development Bank. Remember, I always said that these would merge, SCO and BRICS. They're going to merge. They have the same goals and largely many of the same participants. India has more to lose by ending its purchase of Russian oil than it does if it stopped trading with the United States, even though we're their largest trading partner. It amounts to less than 2% of their GDP. 1.9%. I think we're getting to the end, and that is it, with the exception of one other thing. We're seeing insured deposits shrink out of the banks. In particular, the regional banks and the small banks, and a lot of money is finding competition with digital banks and stable coins. And wait till you see what happens with all of these stable coins, with fintechs and stable coins offering higher yields and lower fees and instant transfers because they don't have brick and mortar, and they don't have ATMs and all this stuff. We're not out of the woods yet with the banks. And the more we start moving towards this digital system of stable coins, you're going to massively erode the stickiness of bank deposits, and which has been the foundation of bank stability. If the Fed cuts rates, banks are going to earn less from lending, but still need to pay competitive deposit rates, which squeezes the margins and makes the weaker regional banks more vulnerable. Think of Bank of Lindsay, Oklahoma. I don't know. I think that the end of the banking issue is not behind us. If one major institution cracks in confidence, the fallout could be severe, because you're going to see a greater concentration of money move out of the small and regional banks, both into the too big to fail banks, like we've always talked about. This is what they want. And also into a handful of these fintech institutions, which again will all be one-to-one backed by U.S. dollars and treasuries. And that is all I got. Happy to answer any questions or any comments. And
here's the brutal reality. Silver supply is shrinking while demand is exploding, and the numbers don't add up. Global mine production has been stuck around 800 million ounces a year, but industrial and investment demand together are expected to top 1 billion ounces in 2025. That leaves a gaping deficit of roughly 200 million ounces, the 5th straight year of shortfall. The Silver Institute has been warning about this imbalance, but the market continues to sleepwalk toward crisis. Recycling can't fill the gap. Scrap recovery is flat, and most of the silver embedded in solar panels, electronics, and EVs is uneconomical to reclaim. At the same time, major mines are struggling, grades are falling, new discoveries are scarce, and environmental restrictions are choking expansion projects. Even Peru and Mexico, the world's largest producers, are seeing output stagnate despite rising demand. This isn't just a temporary squeeze, it's structural. Every year, the deficit compounds, draining above-ground inventories and drawing down Comex and London vaults. At some point, the market will hit a wall where available supply simply isn't there to meet physical demand. And when that moment arrives, silver's price won't climb slowly. It will gap higher, violently, as industries and investors scramble for ounces that no longer exist at current prices. The setup is clear. Silver's deficit is the fuse, and all it needs now is a spark.
I will say this: if you look at the amount of deposits held in banks, it's falling, which tells me the wealthy people don't keep their money in cash. They don't. And that's why they're wealthy. This is specifically why the wealthy people own assets. Because what has happened in the last 8 months? Gold's up 40%, the dollar's down 11%. Look at the value of the dollar since you were a kid. I talk about this, I've mentioned many times probably on your show. When my parents got married in '63, my dad said he could live, he and my mom, on $6,000 a year, easy. And after a while, after saying that, I'm like, this can't be true. I just looked it up the other day. What is the average salary in '63 in the United States? It was 10 grand. So, he was just first year out of college. That's fair. And you could live comfortably, 2 people. I mean, how many people can live a month right now on 6 grand, or a week these days, it seems? It's, I just think that the value of the dollar is dying, and it's starting to become exponential. So, keeping your money in dollars is the worst thing to do. Assets would be far better. And what assets can you choose right now in a position just like this, where because of distortion in interest rates, these assets have all become gotten to a level where price discovery is questionable, to say the least. So yeah, I think that, and it's funny because gold and silver were the ones that were always held down in that environment to support this illusion. Remember, low interest rates, Gibson's paradox says low interest rates is completely inverted to the value of gold. So if you have low interest rates, you should have high gold and vice versa. Well, if you're going to suppress interest rates and you're going to hollow out your manufacturing, you might as well kill the canary in the gold mine. And that's why they did it for so long. They stepped on gold and silver to support this illusion. And they're being called out on it now by sophisticated investors. It's coming to an end. You're going to see gold and silver continue to go higher, and you're going to see the dollar lose value. Remember, Stephen Mirren, who wrote the Mar-a-Lago Accord, who's on the Fed right now, talks about it. Trump talks about it. Besant is talking about it. They want a devalued dollar. They want low interest rates and a devalued dollar. In that environment, you get inflation, you get high asset prices, you get high cost of living, and easier to pay off your debt. You stay in dollars, you're going to go broke. And as Rick says, you're not a contrarian, you're damn well going to be a victim. This is the time. It's getting to that hockey stick stage part. And I don't know, do a little due diligence on your own, folks, and you'll see that a lot of what I'm saying has teeth to it. Nothing ever works out exactly the way we think, but I see this just as clearly as I did the BRICS way back when, and when no one was talking about it, I was. Now everyone is. I'm telling you, you're going to hear more about gold revaluation, about dollar devaluation, about lower interest rates, about Fed losing independence, about a shift, a rotation, as Michael Oliver calls it, once in a 50-year rotation from one asset class to another. These things are all converging. So I don't know. This is the time, and I'll stick by that, and I mean it in my soul. This is the time.
If you want to see just how fragile this market really is, look at the short squeeze setup building in silver. For years, the big banks have kept prices suppressed with relentless paper shorting, creating a mountain of exposure that works fine, until investors start demanding the metal itself. Right now, SLV short interest is hovering around 54 million shares, while Comex inventories are shrinking. That combination is a powder keg. Here's how it plays out. As physical demand accelerates, whether from sovereign buyers, hedge funds, or industrial giants, the shorts face a brutal choice. They can either deliver real metal, which is increasingly scarce, or they can buy back their positions at higher and higher prices. The second that confidence cracks, the scramble to cover could send silver into a vertical launch. We've seen smaller versions of this before. In 1980, when the Hunt brothers tried to corner the market, silver rocketed nearly tenfold in months. In 2011, a wave of investor demand pushed prices from under $10 to nearly $50. But this time, the setup is far bigger. With deficits running at 200 million ounces a year and inventories dwindling, the shorts are trapped. One spark, maybe a geopolitical shock, maybe a surge in industrial demand, could trigger the rush, and when it happens, silver won't just climb, it will detonate, leaving Wall Street scrambling to contain the fire they themselves lit.
I think that's kind of the key. But when you see this, not only the front running by the central banks, whoever's doing it here in the United States, when you see the absolute certainty that you're going to see a devalued dollar and lower interest rates, which will, what's that going to do to the back end of the market? Are there ramifications in the banks? All these things are connected. And when you take a step back, the only place that I would put my money where most of these things, if they play out negatively, I think gold is a benefactor, silver too. But I think you don't buy to become wealthy. You buy because it is wealth, and the biggest money in the world is showing you there are very few places safely to put your money other than gold and silver. So that would be my choice. Forget about the fact that I own a company that does it. I'm trying to be completely objective. I don't know, man. Where do you want to put it? If I give you a $100 million bill right now, where are you going to put it? You know, you're going to put it in ultra short treasuries, maybe. You're going backwards. You're going to put it in real estate, maybe a little bit, but at all-time high valuations. Stocks, all-time high valuations when the insiders are leaving. I don't know. The choices are fewer and further between. How about gold and silver, which have no counterparty liability, that have outperformed everything, that the biggest money in the world is copiously buying, and many are securing their own. So central banks, commercial banks, very large institutions, and sophisticated investors. So take your pick. Trust me, or listen to what I have to say, or don't. I mean, I spend a lot of time trying to figure it out, and I'm speaking not to you, I'm speaking to everyone out there. I mean, I don't know. I don't know where else to put it, and I think hard about it. I mean, you can put little bits here and there, but the trade-off between risk and reward in so many places right now, in all of this unknown monetary, soup, I think there are a lot of things that just aren't worth the risk right now.
History has already shown us what happens when silver breaks free, and the parallels today are impossible to ignore. In 1980, amid inflation fears and geopolitical turmoil, silver blasted from under $6 to nearly $50 in a matter of months, a gain of more than 700%. Then again in 2011, as the world reeled from the financial crisis, silver surged from $9 to almost $50, delivering over 400% returns. Both times, the pattern was the same. Gold moved first, capturing attention, but silver followed with explosive force, outperforming everything in sight. Now look at where we are. Gold has already ripped past $3,600, shattering records and drawing global headlines. Silver, meanwhile, is barely above $30, still languishing far below its historical highs. That's the exact setup we've seen before, the calm before silver's storm. And each time, the moves weren't gradual. They were violent, sudden, and life-changing for anyone positioned ahead of the curve. The difference today is that the drivers are even stronger. Back then, deficits were small compared to today's 200 million ounce shortfall. Industrial demand was a fraction of what it is now. And central banks weren't dumping U.S. debt at the scale we're witnessing today. In other words, the spring is wound tighter than ever. History doesn't just rhyme. It's screaming that another silver eruption is imminent. And this one could make $50 look like a mere stepping stone.
Oh, that's great. I mean, you're right. And maybe God bless, DeSantis down here in Florida, who's trying to get rid of property tax. But you're right. And so all of those distortions that are created through suppression of interest rates, there's always consequences, some intended, some unintended, that happen through messing with Mother Nature. And you're right. The house values have come down because no one wants to move based upon the value or the rate that they're locked in at. And Trump talks about lowering rates to make new houses more affordable, but really it would be higher rates that would make them more affordable, not lower rates. Yes, you can take out more debt with lower rates, but higher rates would find that equilibrium finally between interest rates and assets. In a low interest rate environment, assets really go to the moon. And so by lowering rates and devaluing the dollar, again, you're just benefiting the 1% whose assets will continue to march higher in that environment. These are very, very crazy times. So where do you put your money? Because of the suppression in interest rates and the distortion of asset prices for all of these years, asset prices, to invest into assets right now at all-time highs, you have to wonder, do they continue to go higher? I just happen to believe that there are very few places that offer the kind of appeal right now, not always, but right now, that gold and silver do. And I think you are seeing sophisticated investors wake up to that. Again, who the hell is taking possession of billions of dollars worth of gold and silver every single month? Now, when I say possession can be held in your personal storage account unencumbered in a Comex vault, sure, or it can be taking off the Comex. Both are happening, but big money nonetheless. This is money that is not just big; it's sophisticated, it's well informed.
What makes this moment unlike any silver rally in history is the convergence of forces. In 1980 and 2011, silver exploded largely on financial panic and speculative demand. But today, we have something entirely new: a perfect storm of monetary collapse, industrial supercycle, and structural supply failure all happening at once. On the monetary side, the dollar is being rejected on the global stage as BRICS and central banks abandon treasuries for real assets. Gold has already absorbed the spotlight, but silver is the levered play, smaller, tighter, and primed for bigger percentage gains. On the industrial side, demand has gone parabolic, with solar, EVs, and AI infrastructure consuming silver faster than it can be mined. Unlike gold, silver doesn't sit in vaults gathering dust. It's used up, locked away in products, and effectively disappears from circulation. And on the supply side, deficits are mounting year after year, with no new major mines on the horizon to close the gap. Recycling can't keep up, and existing stockpiles are being drained. Layer on top of this the massive short positions and growing distrust of paper ETFs like SLV, and you get a system built on illusions that can shatter at any moment. This is why analysts say the coming silver breakout won't just mirror the past, it will dwarf it. For the first time ever, every pillar of the market is pointing in the same direction. And when all of these forces converge, silver won't just spike, it will rewrite the entire narrative of precious metals. We are now standing at the apex of a 50-year cycle, and the signs could not be clearer. Silver is the fuse for the greatest capital rotation of our lifetimes. The Federal Reserve's surrender has stripped the dollar of its credibility. BRICS and central banks are dumping U.S. debt, and confidence in paper promises is evaporating. Gold has already surged, but silver, undervalued, suppressed, and structurally scarce, is set to deliver the shockwave. This isn't just about price charts. It's about a global system losing faith in fiat money and rushing toward real assets. With industrial demand devouring supply, deficits mounting, and inventories dwindling, silver is positioned to go not just to $50 or $100, but potentially to $500 and beyond. What was once unthinkable is now inevitable as the dollar melts down and the world reprices tangible wealth. The mega rotation has begun, and those who see it early will be on the right side of history. If you want to stay ahead of this seismic shift, make sure you're subscribed, because the moves coming in silver will blindside the unprepared. And remember, this is not financial advice. Always speak to a licensed professional before making any investment decisions.